What's up, guys? Welcome back to This Just In. Thank you for joining me today. In this video, we got to talk about Paysafe. That stock got absolutely killed last week. It was down 44% in just one of the sessions. So we got to figure out what in the heck happened. I might have made a big mistake on this stock, guys, and I'm one of the first to admit when I'm wrong. So we got to figure out, is Paysafe stock really worth $4? Or was that a huge overreaction? Once we identify that, we can decide if this is a great buying opportunity to average down, or should we be headed for the hills? So let's jump right in. All right, guys, before we get started today, subscribe to the channel for me. Remember to hit that little bell. That way you get notified every time I post a new video. There's also a link down in the top pinned comment to my Patreon account. Come over and join the family. We've got an awesome community over there. We've got 9 spots left down on that $10 tier. So if you've been thinking about it, great time to take advantage of it. That'll get you access to the private Discord where we talk stocks. You'll be able to check out my portfolio with all of my high conviction fundamental analysis plays. You'll also get all of my swing trade setups, which in my opinion is absolutely the most valuable aspect. We've had a ton of winners lately. I send out all my charts mapped out with exactly what I look for so you can learn to identify them. That way you can learn how to find those trades on your own. You'll also just get access to a ton of just general education like books and graphs that you can use to just become a much better investor. So whether you're a long-term investor based on fundamentals, or you're a short-term swing trader or want to become a swing trader, I think I got what you need over there. Day one squad, I love you so much. Thank you for your support. It means more to me than you will ever know. Thank you for everybody that's been joining over the past week. It really is amazing, and you have no idea how much I love you. But guys, we got to get started. Real quick, go follow me on Instagram and Twitter. I will link those down in the description if you want to talk with me or if you want to follow me on a closer basis. I do post pretty frequently on there with just updates and things like that, and I would really appreciate it. Guys, I got to get straight to the point. I can't hide from this one. For those of you guys that are new to the channel, I have been making videos on Paysafe stock for months now. It's probably one of my more frequent videos, and it has gotten absolutely destroyed over the last couple of months. Not every stock that you pick, guys, is going to be a winner. Some of them aren't, they're just not going to go your way. But at some point, you got to learn when to take your losses and move into something else. So I wanted to make this video and figure out, is Paysafe that stock that we should just take our losses and move on to something else? I also wanted to kind of address some of the comments that I've got because I've gotten a lot of them, people asking me what I think, or, if this is really the value of Paysafe stock in the low $4 range. I wanted to give you my thoughts on the whole situation and kind of tell you if I'm worried about it, if I'm, selling out, or if I'm buying more, or what I'm doing. Guys, Paysafe stock has done nothing but underperform week in and week out since all of the other SPACs started selling off at the end of February, earlier in the year. Most of the SPACs started getting killed around that time. All the high growth, high multiple stocks, they started trading to the downside. They started to find their bottom in, May and April. Then they, dumped again. Paysafe was really the only one that didn't have a nice solid rally within those months, even if it had a rally and then dumped further like some of the other ones like Lightning E-Motors. It didn't even get that attempted rally. It's pretty much traded to the downside the entire time. Now, with that being said, guys, I am a long-term conviction hold on this stock. At least I thought I was. I want to talk about something for just a second here. I know a lot of people talk about when you have conviction in a stock, you should have conviction and that should never stray and you should just hold on to it and buy the dip no matter what. Now, I agree with that to a certain extent. Yes, when you have conviction in a stock, you shouldn't worry about the day-to-day volatility. However, when you have conviction in a stock, if nothing changes within the company and the fundamentals and the stock pulls back or takes a dip, maybe you should look at buying more, or maybe you should just not even worry about it. However, If you have conviction in a stock and something happens with the earnings or the fundamentals change or something changes with inside the company, you always should reconsider. I'm sure some of you have heard the quote that success is not owned, it is leased, and rent is due every single day. Well, your conviction in a stock is very similar. You don't just build conviction in a stock the first time you analyze it and then have it forever. Conviction in a stock is not owned. It is leased, and rent is due every single day. These companies have to earn your conviction. Things change with inside companies all the time. And so if they release an earnings report or something changes with inside the company and their growth is just not what they said it is, then maybe you should reconsider. I just want to take this time to go over the actual earnings report that caused Paysafe stock to get beat. And I also want to give you my thoughts of what the intrinsic value of the stock is today. So first thing we're going to take a look at is the earnings report, the guidance that actually made it dump. We're going to take a look at the discounted free cash flow model. Then we'll take a look at the chart and I'll give you my thoughts on where I see the Paysafe stock going for the rest of the year. So let's get started with the earnings. All right, guys, first thing we're going to take a look at here. As you can see here, Paysafe stock drops 22% after guidance cut on digital wallet challenges. Guys, some of you guys have maybe seen some of my other videos where I mentioned how a lot of these SPACs, high multiple growth stocks that came out with insane guidance or huge revenue growth year over year, during the SPAC craze when new SPACs were coming out every day, they were all running to the moon. We talked about how those companies that issued insane guidance were going to get absolutely destroyed if they issued that guidance and then missed. Paysafe really wasn't one of those stocks. It didn't really issue insane guidance. I mean, they were only guiding for about 10% revenue growth, year over year, which is not that bad. Most of the other ones were issuing for, 50, 60, 80% revenue growth year over year over year, and they hadn't even done revenue yet. It's a little bit different when, the company is doing $1.4 billion in revenue already as it is. So I want to just kind of go over this and show you some of the key points here. They didn't get wrecked 44% in a day because they missed earnings for say. It was more so because they missed guidance. They're not missed. They lowered and softened forward guidance. Guys, revenue growth has never been Paysafe's strong suit. In my last video on Paysafe, I talked about how the reason why I invested in Paysafe was because of its free cash flow. I think they are going to do a very good job at growing and building a ton of free cash flow. That's kind of the metric that does it for me. 10% revenue growth is not very impressive. 10% revenue growth is way behind most of its peers in the industry and space. However, they do a good job at building good cash flow. And I think as the different market segments start to open up, I just saw an article about how New York is starting to open up for online gambling. I think once sports get back, I think as the economy starts to get back to where we need to be, levels out, they're going to do just fine. And they will be that company that just dumps free cash flow every quarter, year in and year out. So that's what it is for me, guys. But I wanted to show you this anyways, because this is why it got killed. I feel like most retail investors don't look as deep as a lot of those underlying metrics, such as their free cash flow. They mainly all just look at the revenue growth year over year and think, is it good or is it not? Is it a lot of revenue growth or is it no revenue growth? And that's kind of why they make their decisions. Guys, when you get stocks like this, when you get earnings reports that come out and guidance is weak, especially on a stock like Paysafe that's been shorted to all oblivion, and you've got a lot of these, institutions that are just pushing it down and pushing it down, it just is a chain reaction. Earnings comes out, institutions that are already shorting the stock just pile on even more. So it starts sending the stock down. Then retail, investors that were only looking at the revenue growth or investing into it because the hype, even though I don't even see how there was hype in this stock, start panicking and dumping the stock. So it just accelerates and just shoves it down so unbelievably far. Now, the way I see it is from the standpoint of the composite operator. I mean, if I was the composite operator and a company like this, posted some weak earnings, or I knew that the guidance and the earnings were going to be softened, I would pile on and shove it down as far as I could, because you can see here, there's bullish ratings on this stock. institutions like this stock, for the most part. A lot of them do. And if they can pick this up at $4 from panicking, retail investors that are dumping it, because that sucked. That 44% dump was not easy to swallow, guys. It hurts. I understand that. But most of the retail is going to dump their stocks at that lower price. They're going to take the loss and they're going to get out because they can't handle the volatility. And in my opinion, that's the worst thing you can do in a situation like this, because you've got to think it's going to come back up after a big dump like that. But I want to touch on a couple key points here. I won't bore you with everything. One thing, guys, you can see here, the Q3 revenue fell short, partly due to market and performance challenges in its digital wallet business. That was the big issue, guys. The company now expects full year 2021 revenue of 1.47 to 1.48 billion versus their previous expected guidance of 1.53 to 1.55 billion. Then the analysts were expecting about 1.54 billion. So you can see not an insane dump there, not an insane difference. 1.47 to 1.48 versus 1.53 to 1.58. It's not, or 1.55. It's not like it was down, 20%, but nonetheless still down. They cut their full year gross profit from 880 from 930 to 970. So they cut it down from 930, 970 down to 870, 880. Obviously not good to see gross profit go down. As far as the adjusted EBITDA, they cut that as well from 480, 495 down to 425, 435. This is what we can expect moving forward. They expect, Q4 revenue of 355 to 365 million, which is less than the 406 million. That was a consensus estimate. And then as far as gross profit in Q4, they're expecting 205 to 215 million versus the 208.7 million that they reported this quarter in Q3. And then as far as adjusted EBITDA in Q4, they're expecting 90 to 100 million versus the 106 million they posted in Q3. So you can see, guys, they're already guiding to do less in Q4 than they did in Q3. That's an issue for people. Some people can't handle that. A lot of people get scared when you see declining, aspects or metrics like that. People don't like that. And it scares a lot of investors to dump the stock. Again, guys, 1 quarter, 1 year, not that big of an issue for me, especially when you look at where the stock is right now. If it was at, close to all-time highs and it dumped 40% and it still had, 40% to get back to its lows, that would be a different story, but that's not the case here. A couple other things, guys. I just wanted to show you this right here. The integrated processing revenue, their integrated payment processing was actually up 3.5% year over year. Their digital wallet revenue was down 15%. That's a huge hit to take on that digital wallet segment. And then their Ecash solutions was actually up 10%. So 2 out of their 3 segments, guys, was positive. Just that one digital wallet segment got absolutely murdered. And so I think if you were to take that and you were to just make it even, if there was no growth there, but there wasn't that 15% loss, they actually would have done just fine, probably even beat expectations, but that digital wallet segment killed it. I like to see that it was just one, because that could be anything. That could be issues within the market, natural short-term headwinds, things like that. If all 3 of them were down substantially, that's a different story, and that's something that would be much more concerning to me. All right, last thing here, guys, you can see before we jump over to that discounted free cash flow sheet, the Q3 net loss was 147.2 million versus a loss of 38.1 million in the year ago quarter, which includes a non-cash impairment charge of 322.2 million to reduce the carrying value of intangible assets in the digital wallet segment. Guys, one risk that they do have that kind of, I like to look into, they have a lot of debt. They've got a lot of leverage debt as well, which could absolutely, be a headwind moving forward. So something to definitely take in consideration there. But let's jump over and take a look at that fundamental analysis. Well, this is a discounted free cash flow model. So it looks at the cash flow. Again, guys, the cash flow is why I like Paysafe. I think they can become a cash flow machine. As you can see, I put in all the different metrics. I put in the $4.22 stock price from the time of recording, the diluted shares, most recent revenue, net income, and free cash flow. Now, this is all trailing 12 months numbers. And then I put in their growth rate, guys, and I put them in as conservative as possible. Now, as you can see, for their revenue growth, we can mess with that number a little bit, but I have it in there right now as 8% revenue growth from right now for the next 5 years. As far as their net income margin, -6% because that's what it's at today. And then as far as their free cash flow margin, I put it in at 20%. It's actually about 20.8% as of today in their trailing 12 months. So about right in line with what they're doing. Now, as far as revenue growth, again, that's going to be the number that you're going to have to make your assumptions on. But you can clearly see, guys, the stock price or the intrinsic value of the stock as of today based off of their free cash flow should be around $11.50, which is 172% upside from its current levels. Guys, there is way more room to the upside than there is to the downside. So these are the absolute worst time to sell Paysafe stock. If you are already in it, you've got a couple options. You can either average way down, like my average cost is right around $10. So if I was to average down at the low $4, it would bring my average price around $7 or $8. Then all you have to do is wait for it to get back up and close that gap, and then you can get out without a, very minimal loss and move into something else. Or if you've got a lot of conviction in it, you can just average down and hang on tight. So guys, but as you can see, $11.50. I can't see Paysafe stock going down much further than where it is today. I think it was a massive overreaction. I think it was contributed to a huge amount of short sellers in it, a lot of panic in retail investors, and we're in a market right now that is not rewarding weakness. Any sign of weakness that these companies pose get absolutely exploited and killed. So with that being said, guys, if we change up the actual revenue growth a little bit, because again, they have guided for around 10% revenue growth, but we'll bring that down. Like, let's just say we even go down as low as 6%. You can see it still brings the stock price to $10.60, which is way above where it is today. So I do not think that the $4 stock price is anywhere close to the actual value of the company. I think it is very far detached, and you can make some decent returns at these levels on the way back up to the upside. Now, if we, want to be optimistic and we throw a 10% revenue growth in here, you can see it brings the stock price up to around $12.50. So I think if they can, really step up and show investors that their revenue growth is going to be, towards that high end of around 9, 10, 11% over the course of the next 5 years, I think they will recover and do just fine. I think as the market comes back, I think as, New York and all these other states legalize online gambling, I think their other segments are really going to start doing well and they're going to be just fine. But I wanted to show you this, guys, because this is why I am not worried. This is why I am not bothered by the big sell-off. This is why I'm not bothered by the decrease in guidance. But I will tell you this, I'm going to be keeping my eye very close on Paysafe, because if they continue to show a lot of weakness like this, I will probably wait for them to get back to close to where I was at as far as my break even goes, get out and move into something else, because I'm not just going to sit into a stock that's going to continue to underperform, and underperform for years to come. It's getting real close to end of 2021, right? And I either need to take my tax loss or I need to plan on holding it for the long term, because I don't want to go an entire another year holding a stock that is going to underperform the market that bad. So you've got to take that into consideration, guys. What I'm currently doing, I'm thinking about averaging down, bringing my cost down to get my break even a little bit closer. Or I'm thinking about just holding off and, holding it for the long term. I will let you know and keep you updated, but that's kind of what I'm doing as of today, guys. Let's jump over and take a look at the chart and we'll wrap it up. So as you guys can see here, really, really bad looking chart, guys. I mean, done nothing but trade to the downside ever since it peaked out, hit that top at $19.57 in the end of January, rolled over and just dumped. Like I said, guys, a lot of those other SPACs, SoFi and some of the other ones we talk about, they found their bottoms in like March, and then they had a decent attempted rally before, rolling over and dumping again. But like SoFi, they never went past their mid-March lows. Paysafe did. They found a bottom, attempted rally, make a lower high than the previous high, roll over, dump again, make a lower low than the previous low, and every single time it tried to find a base, it would just roll over and continue to dump even further. This downward channel, guys, is actually being respected. So you can kind of see it stayed in this channel, tried to breach it a couple of times. And one thing that I actually like more locally is you can see it actually started to breach that channel, tried to back test it, successfully back tested it, but that 50-day moving average was just holding it down. I actually thought it was going to break that moving average and start heading back up to the upside. Then earnings came out and it just got killed. But notice where it fell to, guys. I mean, it respected that heart line of that trend channel perfectly. So it absolutely could pivot here and run back up to close that gap. But guys, look at how much downside you have to go to zero right there versus how much upside you have even to get back to where it was before the dump and that $10 NAV price right there. You've got a lot more upside than you do downside. And so these are the absolute worst levels to sell this stock at. However, this is also the worst looking stock chart I think I've ever seen. Not literally, but it's bad, guys. This is not what you want to see. This is not what you want to buy into. However, if you plan on holding it for the long term, you've got a lot of conviction in it. You plan on, just averaging in or continuing to buy it on any signs of weakness. This is a good price to buy it at. If it can continue to hold this heart line, guys, I think you're at a minimum going back to close this gap. Now, you very, very well could just sit here and trade sideways for a long time. We're just going to have to see what happens. I think at the very minimum, it's going to trade sideways and then start to work its way back up. I don't think you're going to come down here and test the bottom of the channel, guys. That would put the stock at like 60 something cents, $1. And I just think that would be lunacy if it did that. Now, it very well could. I'm not saying it couldn't do that, but I don't think you're going to drop past that level right there around $4. I think $4 will be the bottom. But as you can see, I mean, if it continues in this direction, $3, it could absolutely see it. However, I want to see it, bullishly engulf on Monday, or at least open up here, jump up a couple of percentage in pre-market and then make its way back up. We gotta break out of this channel, guys. If we can break this channel, back test it as support, I think we have a good chance of starting to move up to the upside. You can see here, guys, the lowest level of negative momentum on the daily you have seen since back here in March. And as far as the relative strength index, the lowest level ever since the stock opened back in October. So I just don't think that there's that much more downside in it. It makes more sense for institutions to flip it and start riding it back up and pushing it back up to the upside. And I think there's enough value down at these levels that you will see retail to pile in behind it. It had a really strong day on Friday. It closed at like 6% on the upside. So it's actually, showing some sign of recovery. So that's it for today, guys. Take this analysis, do with it what you want. Let me know down in the comments if you agree with me. Let me know if you don't agree with me. This video is for entertainment purposes only. I am not a licensed stockbroker. Always do your own research and due diligence. Don't just take my word for it. Come over and join us at the Patreon if you want to be part of an amazing family, and I'll see you guys in the next one. Peace.